Thank you guys for coming. I really appreciate it. We've got Mike Hughes, Jerry Murphy, Kent Williams, Donald Ross, and I am Christian Ross. I think I have a couple topics I want to talk about, but before we spend a ton of time on those items, I did want to talk with Kent. Kent, do you have anything that kind of, that you're seeing in the market? I know aren't they increasing rates or the fees for certain loans through Fannie Mae and Freddie Mac?
Yeah, I've had a couple conversations this morning. It's called a loan level pricing adjustment. And what's been happening is it's something else that the government's trying to do to fight inflation. Unfortunately, it affects people that are at better credit scores with better down payment are subsidizing lower credit scores with lower down payments by having a price increase to your rate or the pricing on your loan. There are ways to combat it and kind of loopholes to work around that. It'd be a long conversation that we would have to have, so I'll cut it short. But there are ways to do things like I priced a loan yesterday that with 20% down was higher than 10% down. So I priced it with 10% down with a one-time PMI payment that got put into closing. They don't have a monthly mortgage insurance payment. We put that in their closing costs and they have a lower rate. So there are different things that you can do.
You're doing a lump sum on the PMI, 10%
Correct.
down. Is there any
Correct.
reason you wouldn't do a normal PMI and then just have the borrower put down the additional 10% and recast it?
Well, just because of the monthly amount, it's just a monthly payment. So you're going to be paying that monthly amount until you get to your 20% down. So you're just paying that. You're burning money with MI.
Yeah, but I mean, in that scenario, right, Kent, wouldn't that borrower, they were intending on putting the 20% down anyway, so seemingly they have that capital, and right after closing they could make a recast and get the
it's a math equation. So what you basically look at is what's the difference in payment with rate and how long you're going to have that loan. If you're going to have that loan for longer than what the cost of that payment is, then it makes sense. But it's literally a math equation. But there's ways to work around it. Versus if you do 25% down, that LLPA goes away. So there's different things to do.
Oh, interesting. So it's really just the 20% that they're the ones that are going to be hit the most.
Yeah, because at 20% down, there's still significant risk to default versus 25 or 30% down.
Okay.
So 20% is kind of the one that's getting whacked the hardest. Yeah.
Okay. So, and I've always kind of heard you've got the people that are really strongly in the court of avoiding PMI at all costs, making sure that you put the minimum 20% down, possibly more. But then there really is a whole subset of investors that believe that PMI is not that big of a deal. And that if you put the minimum amount down, you can actually maximize your total investment dollars, something like that. Sounds like this is kind of going to steer people more in one direction or the other.
Well, for instance, an FHA rate with 3.5% down is lower than a Fannie Mae rate with 20% down.
Interesting.
It's a government backed. It's just about risk. Everything in
our business. Now, for an FHA, not everyone can. Like, could someone with good credit get an FHA loan?
Oh, absolutely, for sure.
And so there's no limit
if it's a primary residence. No, if you're not putting 20% down, you absolutely should be doing an FHA loan.
Interesting. So, and so the only downside with an FHA loan is that you can't get rid of the PMI ever, right?
Correct.
So but it does go down with every payment. So as you draw down the principal, your PMI does go down. I think is it annually that it gets recalculated, or is that almost monthly? I don't know.
It's annually. Yeah.
Annually. Okay. It's so this is a really good transition into the topic I wanted to talk to, because we've seen since 2020, and even before then, really since like 2011 or 2013, we've seen this incredible bull market in real estate, and now we're having to pay for it. And your scenario with this new fee is part of that. Other ways that people are seeing the real cost of this is in property taxes. We're seeing incredible property taxes. I did a video just a couple of weeks ago about homestead. You can catch that on YouTube if you missed it. We talked about the benefits of the homestead exemption here in Florida, and it's more than just taxes, but it's a huge part of it. we're seeing also people that are getting hit with insurance increases because the properties are a lot more expensive. And even if we weren't dealing with increased climate change potentially and all that stuff, even if we weren't seeing that, to insure a more expensive property costs more, right? So people are having to pay that bill. And then the other thing that I wanted to really point to was capital gains, because if you buy a property for $500,000 and you experience this incredible bull market, now you want to sell it for $1 million, you could get hit with a lot in taxes. So that's the scenario I wanted to look at. And you could look at it from 2 different, possibly 3 different perspectives. And so perspective number 1 is the primary residence, husband and wife own a house, they paid $500,000 for it, and now it's worth $1 million, and they want to upgrade. Dad, someone in our family is kind of thinking they're not going to move, but this is how they would think about it.
Sure.
They have this house that's appreciated in value quite drastically. They need more space. They're talking to Kent about maybe getting a new loan on a more expensive house, and he's saying, hey, look, there are additional fees. Maybe we can work out something that works for you. But then on the other side of it, what happens if you sell an appreciated asset? You would think you have to pay taxes on that, right? That's kind of the big concern.
You would think, I mean, we're talking about your sister, I take it, because she hasn't mentioned this.
No, she's not. It's a hypothetical.
Yeah, hypothetically, if your sister, because
getting her in trouble for no reason.
If she has 4,000 children, which she does at this point, and wants to move to a larger house, if her and Dan have owned the house for two of the last 5 years, they can exclude up to $500,000 in gain. So they can avoid the tax entirely in using your hypothetical.
Yeah, exactly. So there are rules where if it's your primary residence, and Dad, you mentioned 2 out of the last 5 years, it was your primary residence. When you sell, the IRS gives you a $500,000 exemption against that gain because it's
married couples. If you're a single person, it's $250,000.
Right. So if let's say they were unmarried and they both own the property, they would each have a $250,000 exemption, and you'd still get that full $500,000 potentially.
Right.
So in that hypothetical, my sister could sell her property and buy something else without having to pay $1 in taxes. Pretty cool. But there are a couple of exceptions to that. What if you didn't have full 2 years? What if it's not your primary residence? What if the gain is more than $500,000? And what if we put a lot of money into the property, right? So there's so many what ifs. One of the dangers that I'm seeing, and I know you guys are probably going to fight with this if you haven't already, is that your client calls you and says, you know, I read online, or I heard from my neighbor that you shouldn't have to pay taxes on the sale of real estate. Or they say, especially in this town, well, when I sold my house in 1988, I just rolled the profit into the next property. Can't I just do that?
They had a different code section back then on homes.
Right.
So as long as it was the same or more, you could exclude that on your primary residence. But they changed that code section like 3 times in the last 30 years.
And so it's no different than how these real estate contracts evolve, how mortgages evolve, how even title insurance has evolved in the cost of it. I get a lot of blowback when a buyer says, oh my gosh, the title insurance is more expensive than I remember. It's like, well, your property is a lot more expensive. And over the last 30 years, they have changed the promulgated rates. So we just have to combat that anxiety and those concerns with real facts. And that was kind of the point of this. I want to put the broad disclaimer, talk to a tax accountant or a tax attorney before making any tax decisions. Don't rely exclusively on this advice, but I did want to give you guys this basis. So option number 1, primary residence. I'm looking at my board. Primary residence, married couple is up to $500,000 exempted from capital gains. Single person would be up to $250,000 in that same capital gains. Dad, remind me. Actually, I'm going to go to Mike Hughes. Mike, I'm going to catch you on this one. You awake?
Yep.
It's going to be fun. Mike? Now, Mike, you have a history. You have a background in accounting. what is capital gain? How do you define a capital gain? You just call me a
Honestly,
name if you
Christian,
don't want to answer it.
I don't want to answer it because I haven't practiced accounting in probably 25 years. I'm sure
So-
that it's changed a bit.
Mike and I have talked about this topic a lot, and the issue is, so how do you define capital gain? It's essentially profit. It's not exactly a synonym, but it's as close to it to the layperson that I can get to. It's essentially profit. So
Profit
take what
of,
you sell it for minus what you paid for it, and that's your profit. That's also potentially your capital gain. What were you gonna say, Dad?
well, use furniture as an example, capital gain. If you're in the business of selling furniture and you sell furniture, that's not capital gain, that's ordinary income. But if it's just Christian Ross selling his living room set, and you're not in the business of selling your living room set, then that could be a capital gain.
Yeah, this is for the homeowner that is selling.
Like car salesman, that's
Take-
ordinary income when they sell.
That's, yeah,
You
luckily
sell a car, it's a
our
capital
clients
gain.
are, for the most part, unless it's a home builder potentially or some sort of.
Depends on what it's
investor.
used for, is bottom line, that's the definition.
Yeah, so
You also deal with short-term versus long-term, right?
exactly. So can you explain that, Mike? How does that work?
I just explained it.
I'm trying,
year or
man. I'm
more.
trying. All right, short term is less than a year, long term
Less
is
than-
more than a year. So if you had the
Right.
asset for less than a year, you could get taxed at a higher rate. It should match your ordinary income rate. But if you had
Whatever
it
you're
for
at,
at least a
right.
year, you'll get taxed at a potential, at this current time, at a lower rate, either 0%, 15%, or 20%. Now, that does not take into account state taxes. Florida doesn't have state income taxes,
No.
but if you were in a state that had them, then you would have to include that as well. So, all right, so 1031 is the other word. That's the catchword that we always think about. 1031 does have that rollover effect. When you sell a property and you defer the taxes, you defer the capital gain into the next property. And it's a statute in the Internal Revenue Code called,
Right.
it's statute number 1031, 1031. And it's an exchange. It's a like kind exchange. How does that work, Dad? How do you do a 1031?
Well, it flows out of a tax court case called Starker, where somebody sold an apartment building and they escrowed the money in a separate account, earmarked specifically for reinvestment, and they held it for 10 years before reinvesting it. Of course, the IRS challenged it and they lost because the court rule is just a change in form and not of substance of the investment. It's real estate, it's real estate. And the IRS, to combat that 10-year period, came back with code section 1031. You got two-party exchanges where you and I could be exchanging my lot for your lot, investment lots. That's a two-party exchange. You have a three-party exchange where you and you want to buy my lot, but you don't have anything to give me. I have to go get one from somebody else. And that's a three-party exchange where my money from your purchase goes into a special escrow account and I sign a bunch of documents saying it's exchange and I have to identify property and all that jazz. And then they have a reverse exchange where I haven't found the property I want to, I found the
You found
property
the property.
I
Yeah.
found the property I want to replace the lot I'm selling with, but I haven't sold my lot yet. So if I have extra money, I can buy the replacement property first and then sell
Yep.
my lot.
It's complex, but it's a really neat code section, but there are some really very tight restrictions on it. Number one, you'll notice, Dad, you were talking about lot. You kept saying a lot, my lot for your lot. And it's because you can't do this for a property that you're using personally. It's not this, you can't be a primary residence. And if you're going to use it personally, I think there's a restriction. You can't use it for more than 2 weeks, 14 days, I believe. Again, don't rely entirely on this video, but this is really for investment properties only. I always thought of vacant land or a rental property, something that you're truly renting it out, that you have income from the rental that you can show on your tax returns. That's what it's used for. So rolling it over. You sell the typical exchange, you sell one property, you have 6 months to buy the replacement property. They don't let you do 10 years anymore by statute, right? So 6 months to buy the
Yeah,
replacement.
they weren't happy
property.
with the case, so they came up with the statute.
That's right. So Congress passes the statute and it restricts it to 6 months. There are additional restrictions, like you have to identify the property that you're going to buy within 45 days.
The money has to be held by a qualified intermediary, somebody that it can't be an attorney that you use within the last 2 years. You have to identify the property within 45 days of the sale of your property.
It's similar, Dad. Wouldn't you say it's similar to like an IRA or a 401k? Where you
A
can't
little-
touch it.
a
If you
little
take a
bit.
distribution, you're going to have to pay taxes on it.
Yeah, you can't have constructive receipt of the money. You can't have the ability to tell the qualified intermediary that I want the money now.
Yeah.
That's really the reason. And then there's all sorts of variables. Is the house under construction? Is there furniture, which they call boot? So it gets quite convoluted.
It does. Kent, were you going to say something when I saw your
So
emoticon?
I wanted to ask, didn't the 1031 rule change recently where you used to be able to use it for airplanes and boats and all kinds of stuff, and it's just real estate now?
No,
I think there was something, but I don't want to speak to something I'm not familiar with. So you might know more than I do.
I don't know about the airplanes, Kent. I do know you use it for boat slips. You can use it. There was an attorney in town years ago who used it for tables in a restaurant. Believe it or not.
Well, we'll
My
focus
understanding was
entirely-
real property is real property. To be able to use
Well,
it.
it could be a 99-year lease under the code. And the regulations actually get into this in detail.
So I don't want to spend more time talking about the details. I think the key for everyone to realize is the first way to avoid paying capital gains is if it's your primary residence for at least 2 out of the 5 years.
Right.
That one's a good one. That's an exemption on the gain. You'll never have to pay that tax ever. And the other one is for rental properties or vacant lots, truly investment properties. That is the second option, and that's not an exemption, it's a deferral. That one it's got a lot of rules. It's way more complex, and you have to have a 1031 exchange agent involved on the deal. But outside of that, we talked a little bit, Mike, you mentioned short-term versus long-term. That's a good way to think about it. Let's say you don't have the 2 years. Can you at least get the year so that you can reduce your tax rate? That could be very valuable. One of you guys actually mentioned, I think, Dad, you were mentioning furniture. Can you offset furniture? Say you're selling $1 million condo now, but you want to say 50,000 of it was for furniture and really sell the real estate for 950. So instead of a $500,000 gain, you've got a $450,000 gain and a separate sale for furniture of 50. Can you do that? How do you think
You need to separate it, and typically people have paid more for the furniture than what they're selling it for.
Usually,
so
yeah.
If you report it separately, you got a capital loss on the furniture.
Which could help someone in reducing their tax exposure. One key that we always point to is just don't lie about the value of the furniture. When you get too cute and you have a $500,000 in furniture on $1 million condo, you're just asking for trouble. So actually sell the furniture at what it's worth. And then Kent, you don't like furniture. I've cussed in your word 8 times now. What does a lender think about furniture, right? So if your borrower is getting a loan, we can't be doing that, right?
I literally had yesterday an agent wrote a contract that had the furniture in there and used the old phrase being left as a convenience that used to be able to be, that was acceptable, is no longer acceptable, is now an enticement to sell. I don't want anything to do with the furniture. I can't lend on the furniture. Get it out of here. They rewrote the contract.
So I want to warn everybody. Now, Jerry, I'm going to pull you in on this one. You ready for me?
No, but go ahead.
All right. So your lender says exactly what Kent just said. I don't want to know about it. I don't want to see it. I can't lend on it. I've seen realtors just not give the lender anything about the furniture. They'll sell the property for $1 million and the furniture is at zero, but it's a totally separate agreement. It always kind of gives me the shivers because I want the lender to see everything that we have, even if they don't want it. I don't want to be actively hiding something from the lender. Have you had any interaction with that? Do you have any agents that kind of ask about stuff like that?
Never a Downing Fry agent, I know that.
Never.
Never.
But I can't speak for the other agents that aren't as sensitive to issues that don't, that walk a fine line. No, I haven't seen any of that. I've had some questions about that, where somebody says, you used to be able to say for the convenience of the buyer or the seller, whatever the case is, you can't say that anymore.
No. What I would recommend is figure out what the furniture is actually worth and be conservative about it and do a separate personal property agreement with an actual value. So if it's the couch and living room set and maybe a bedroom set, maybe it's $8,000. And you do a separate personal property agreement, $8,000 for the following furniture. And then instead of selling the real estate for $1 million, it's now $992. And you kind of, it's totally separate. You make it close simultaneous with each other. Yes, Mike.
You know, you're hitting some interesting points here. When you're dealing with high-end properties, furniture ends up becoming relevant sometimes. And the one thing that I do see periodically is a seller try to get cute with the furniture, or the buyer try to get cute with the furniture, where they know they agree on the number, but how you allocate that number can be very problematic.
It is problematic. And I would say the number one problem is if there's a loan. So if there's a lender involved, it's a major concern, and you have to be able to have an open dialogue with the lender and say, look, here's what the issue is. How do you want us to set it up? And the answer should not be, name it addendum 1A and 1B. It shouldn't be that. It's addendum 1, 2, 3, and 4, right? You shouldn't be playing funny math with like, oh, well, no one will notice. That's not the solution. The solution is a separate personal property agreement that's meant to close simultaneous with the real estate. And if either of them are in default, they cross default, something like that. And we can help you with that.
The cross default.
The second issue is it really doesn't save on some of these other costs that maybe motivate a seller or a buyer to do it. So buyers are really worried about maybe title insurance cost and property taxes after the sale. They want to keep their purchase price as low as possible so that their property taxes don't jump exponentially. Sellers are worried about paying transfer taxes, which is $7 per thousand, and they're worried about capital gains.
Commissions.
So they both are motivated to get this number low, but the reality is it doesn't save them as much as they think. Dad, you and I have seen it. The county really doesn't care what you paid for the property.
It might not save them a dime.
It probably wouldn't, not in property taxes. The county's going to look at, like if you bought a condo, they're going to look at the whole condo building, every unit in there, and pretty much everyone's going to get taxed similarly based on their square footage and what floor they're on. And they're going to say, all right, well, that's an outlier. I've actually talked to the appraisal's office and they say, we don't look at outliers. We say that's not the thing. We do have a question in here, which is interesting. It says, you said using the verbiage being left at the convenience of buyer and seller isn't allowed anymore. Why do you say it's no longer allowed? And when did that change? What's the risk if it's done another way? And this person says, I had lenders telling me not to include furnishings on the contract, so now I'm confused. Kent, do you know when that might have changed? It's kind of like just a mentality, right? Over the last 5 years.
It was a while ago. I mean, I remember
quite a while.
doing this for, I've been doing this for 22 years. So, but it's been a while. It was before the housing market, 08 thing.
Okay. Yeah, 08 definitely changed the mindset on underwriting guidelines and tightened everything up. I would say that there's really only one way to do it. If you're going to separate it out, that you need to pay money for what it's worth. So on a loan deal, If it's a cash deal, you can do whatever you want. You can include it on the contract. You can put an addendum being the inventory list. If it's a cash deal, and your buyer needs to know that. If it's a loan deal, they really need to be separated out, and you need to be paying for what you're getting. Almost like actually paying for it. And the lender's never going to allow it on the settlement statement either. So if it's $8,000, it's going to be by check or wire directly to the seller, and it's not going to be part of the closing. It's two separate, almost like buying a car on Facebook or something. It's just different.
Yep.
Mike, did you have a point you wanted to talk to?
Yeah, the thing that jumps out at me today, Christian, it's the old saying, as a realtor, stay in your lane.
Yeah.
And the reality is a lot of realtors know a little bit about 1031 exchanges. They know a little bit about capital gains, but they don't know everything about those topics. So you're much better off, in my opinion, is building your team. You know, who is my go-to person? Who's my go-to lawyer when these topics pop up? You're much better off deferring to the experts than trying to wing it, and in all likelihood, you're going to get yourself in trouble.
Yeah.
So, I mean, we're very fortunate here at our company to have Don and Christian down the hallway, and that's something I don't take for granted.
Yeah, I'm trying to find a way to lock the door, that's for sure.
Yeah. We need to stay in our lane, and that is so, it's not a cop-out or anything like that. If you really think about it, you're really doing what's best for your buyer or seller by staying in your lane.
So I think you're right, Mike. You do need to understand when you're going from being the expert about something to just trying to help. And if you're just trying to help, that's fine. But if you start giving actual legal or tax advice, it's very problematic. What I experience, because I'm not a tax attorney, I'm not an expert on this stuff. I have an accountant just like everyone else does. The key for me is when someone calls me and says, I read about this online, can I do it? I think there's some value in having the points, the issue spotting, the ability to very quickly, and Dad, you and I talked about it before this class started, that I wanted to really simplify so that people knew, am I missing something or am I not? And the key is, if it's a primary residence, there is a way to do it. If it's a rental property or vacant land, you have the 1031 way of doing it. But if it's just a second home or a condo that you use part-time and you don't rent it out, there's no way to avoid it. There's only ways to limit it, to keep it as low as possible. And so we talked about furniture. We talked about short-term versus long-term, which could reduce your rate. We also could talk about improvements to a property, and that it's a very tightly defined definition on what is an improvement versus what is repair or maintenance. But lean on your accountant, tell your client to lean on the accountant, make referrals. We have a couple of referral partners that we love, accountants that we use every day, that we'll happily share with you, that answer these questions and prepare tax returns for our clients. So know kind of the basis of this, because if most of your clients, this is a second home here in Naples or Bonita or Marco Island, and they're needing to sell and upgrade, there's really no avoiding the taxes. You're going to pay taxes if you made money on it. If you didn't make money, then you might not have to pay any taxes, but what's the fun in that, right? That's no good. I don't like that. All right, one other thing I wanted to talk about. So Jerry, you're in Bonita. You do a lot of FAR contracts, and we noticed something recently. It's one of those things that we've always known about it, but it's never at the top of our mind. And it's regarding condo applications and HOA applications, so associations. And a lender brought this to our attention recently and said one of his clients got in a lot of trouble because the FAR contracts, both the standard and as-is contracts, require the seller or the listing agent, because we all know how this works, to initiate the contact with the property manager regarding the application. So let me redo that. The seller and listing agent have the obligation to initiate the approval process with the association. So if you as a listing agent don't tell your buyer or the selling agent, hey, you need to go apply, here's the number, here's who you talk to, this is what it's going to cost. If you're not seen doing that, the buyer could say that the seller's in default and the buyer might be able to terminate. And it's this little line in the FAR contracts, doesn't exist in the neighbor contracts, but FAR puts that onus on the seller. Have you ever run into that issue, Jerry? Has that come up at all?
Well, there's always the scrambling when somebody says, oh, I forget to get the condo application filed. But if I was the listing agent, I'd do it anyway.
Of
Even if
course.
I wasn't obligated, because I'm not trusting the buyer's agent.
Yeah. No,
Because
I
I
think,
trust them if there's a CO necessary.
Yeah.
If you don't follow both sides of the deal you're involved in, there's no guarantee, even after you follow both sides, that it's going to close, but at least you know you're on top of it.
I think that's the bigger point, Jerry, is we have to hold people accountable. If the other side isn't going to hold themselves accountable, well, we want to close. We want everyone to be moving in the right directions. You know, from my position, I deal with a lot of other attorneys that I'm not the biggest fan of, that I think they drop the ball or they don't really know what they're doing. It just means I have to work a little harder, because if I realize that they're not on top of it, I'm going to be paying the price just as much as they are. It's not worth it. So if we have to work a little harder.
One of the other things is the condo documents. You know, if the agent doesn't get the condo documents, whatever side they're on, either to or from, it could cost them the deal.
Yeah,
So
totally.
if you're not following both sides of that, you're in trouble.
You are.
I will say, and
Absolutely.
this is self-serving, but I will say, if you're getting a loan, we're going to be down their throat more than you are. So we'll take care
That's
of
helpful.
it.
So I always said that, Kent, because I do actually agree with you 100%. When we do new construction deals, lenders will do the draws. They'll say, all right, you know, we'll pay the first draw after the foundation is poured. We'll do the second
And
draw after
inspection
the
and-
frame
yep.
is built. And that's a huge benefit to have a lender with being that strict. And so I almost recommend, even if you could pay cash, there's a value in having a lender involved, because the seller can't mess around. The seller's
Lender will get the proper releases.
they'll get the proper releases. They'll make sure the title's
Correct.
being updated and all that. And Kent, you made that great point, because that's not just on new construction. That's on every deal. You're going to be pushing for the
Especially
buyer.
condos now. Yeah.
Has the buyer applied to the association? Have they gotten their condo docs? Have they provided all information? Are they getting their insurance in order? If it's totally on you, if you're working with a title company or law firm that's not helping you in those areas, you're missing out, you know, because my company and Kent, your company, Downing Fry and other really good companies here in town, they do go that extra mile. And I think that the expectations should be there. So we're getting there. I think people are realizing
The top
who's actually good.
the top agents that do a lot of business, especially transactions, stay on top of everything.
Yeah.
Okay, it's the agents that do 1 or 2 deals a year or every 6 months, where they're not dotting the i's, don't know what to do.
Yeah.
So the top agents stay top because they follow both sides of the deal.
I love that, Jerry, because people are right out of school. They're not at the same skill level as you, who ran 5
Right,
offices.
and I welcome, if I was an agent beginning here, I'd welcome inexperienced agents covering my butt.
Yeah.
And
All
if
right.
it's-
Well, on
it
that
calls
note,
me-
talking about Jerry's butt, I think we should probably end this meeting.
Well,
Mike,
there's
do you
not
have any
much to
other
talk
words of
about
wisdom
anymore,
for us?
including my ear.
I'm speechless.
Speechless. Well, thank you everybody for joining. This was fun and
Thank you, guys.
hopefully very valuable. So call or email us. Happy to be there for you. And good luck this week. Thank you
All right,
guys.
you too.